Basis Points is supported by SIBO. Hello and welcome to Basis Points by Equity Mates, a show that helps financial advisors find small improvements that compound into big outcomes. I'm Ali Selby, and today we're speaking with industry legend and Platinum co-founder Kerr Neilson. For those who don't know him, Kerr has been heralded as Australia's answer to Warren Buffett, having paved a path as a steadfast contrarian investor in the 90s and early 2000s. He passed over the reins of Platinum, the firm he co-founded in 2018, and has been managing his own money ever since. Today, we'll be discussing why he believes we are witnessing the dawn of a new commodities supercycle, the biggest risks he sees in markets today, and we'll address the rumours that Kerr is about to dip his toe back into managing more than just his $1.65 billion fortune. One final reminder before we get into it, every episode of Basis Points is accredited by the FAAA for CPD points. All you have to do is head to the YouTube description or the podcast show notes and hit the link to complete the quiz. We'll send you your certificate. And don't forget to sign up for the Basis Points newsletter, where you'll get exclusive insights sent straight to your mailbox every week. Thank you so much for joining us today,
Nice meeting
Kerr. Really excited to interview you once again.
You're kind.
It's obviously been a very eventful 12 months for you. You've sold your stake in Platinum to L1. There's word going, there's rumours happening that you are possibly dipping your toe back into active funds management again.
Yes.
Why would you want to go back in? You've been retired for 8 years now, managing your own money. What's the desire to go back into funds management?
Well, a couple of things. One, I only sold 40-odd% of my holding in Platinum, and that was to induce the takeover of the company, so there was order reestablished. That was the first thing. But what we've really been doing, we got a license, so we're prepared to run money if we're so inclined, but our internal funds have been doing extremely well. We've outperformed the market as contrarian stock pickers, so it still works. I suppose I've got to prove that it does work, but I know it works. But that is proof. So since 16, we've outperformed, which is interesting, and that's through the teeth of the Grand Seven, whatever you want to call them, the great companies of the age. What we are doing in a concrete form is we're starting to promote a new fund that's run by the former head of Quant at Platinum. So this opportunity came out of the failure of Platinum, the merger, and as the acquirer, L1, already had a long-short fund, we thought it was appropriate for us to get involved. And so we've seeded this, and it is quite an extraordinary offer. So in the last 5 and a bit years, he's compounded at 14.2% compound, with no down years at all, with no correlation whatsoever to the market. I've not seen an offer like this anywhere. So I'm pretty keen that we're in on this at the ground floor, because what you see with all these hedge funds is that they have a pattern of outcomes that go from southwest to northeast. This has a agglomeration of returns when you look at their daily returns that centers around the middle with a bias towards going up when the market's going down. It's a pretty remarkable fund. Adamantos is its name. It's run by Sava Minik. They're using our offices as they get started. And we're just sort of saying, well, what can we do to help you? And so that part of it will be going around talking with them about that product.
Wow.
So that's what, but anyway, that's not why we're here today. But I have seldom seen a product like this where you have no correlation to the market and superior returns at a time when everyone has been struggling with the power of the Mag 7 and where they should have, as contrarian stock picking built on Quant, they should have underperformed, and they have not. So
it's interesting. We're like in this era of a lot of funds just seem to be less differentiated.
That's right.
Everyone's just hugging the index.
That's right.
And it feels like a lot of advisory firms are also moving more towards an ETF model rather than it being like picking specific fund managers.
Yes.
Do you think that's a good thing for the funds management industry and the financial advice industry?
It's a complete paradox. The more you get crowding, the more you get this sort of herding into one area, either through the bulk of money, which is now run by the big managers, or the ETFs, the attraction of ETFs, the more you're going to leave huge swathes of market without proper price discovery. So without price discovery in the normal form, you're going to get some real inefficiencies in appropriate pricing of stocks. So as we have shown, I mean, stock picking is as alive as ever. It's not faded. I know they're going extinct because it's a sort of unattractive proposition, particularly when you look at the low cost of running an ETF. And what I've always said about ETFs, which I believe in, I think they're a great product, is you've got to know when to get off that particular trade. And that's your big challenge. How do you know when to get off software? Suddenly it's down 35%. So yes, you might still have a good return, but you've left a lot on the table because you've still got that asset allocation process to go through.
Are we in one of those times now?
I think absolutely. We're in a massive change, massive change in leadership, massive change in opportunities. And, we can talk endlessly about AI, the disruption, but we've got economic disruption and we've got political disruption all happening at once. And we've got this war developing now in the Gulf. And how that unfolds is interesting because most observers I'm seeing and the pricing of markets suggests that it's a transient thing. But this is the supply of 20% of the seaborne trade in oil is likely to be for a while disrupted, if not for quite a long while. And the presumption is that it's a short while. And as we've seen in any of these incursions, I mean, Russia's been hard at it for 4 years now, 4+ years in Ukraine. So why should we actually believe it's just going to be over and done with? It's not a good bet. I think the bet would favor you taking a slightly longer term view, in which case there's all sorts of changes in values around the market.
Obviously, you've been investing for yourself 8 years now.
Yeah.
How does your process differ from when you were investing at Platinum? Are you taking more risks? Are you investing in growth opportunities like the rest of the market, or are you still focused on contrarian opportunities?
Being contrarian is interesting because there are times when there's such a strong cycle. You have to go with the cycle, even if you do it in an obtuse way. And that's what we've tended to do. So we were going, instead of buying NVIDIA, we were very happy to buy AMD. And there was a very simple argument. You could buy the crumbs, which were still going to be expressed in very nice returns, and it's proved to be so. So that's how we were tending to, just as we did in 2000 when the market was wild about the dot-com boom and we were playing it in Japan. So there's always a way to play a big trend in a tangential way. But not really. We haven't changed much at all. We had a go at different types of assets over this since 16. We had a go at growth stocks. Some worked out very well, some did not. And so in terms of our total return, we've definitely participated in those things, but as well, it's had a bias towards places like Japan, which were just incredibly cheap. And now you've got this major bull market there. And I think it's a very nice play if you want currency diversification. And we also have quite a lot of money in CAD, Canadian dollar.
Okay.
So, we're playing quite a lot of thematics. We're playing a lot of stocks. So if you look at our portfolio, it's still got too many holdings.
How many holdings is that?
Oh, I'll only admit to about 60, but there's a nice tail of nobodies. And but the core is in things like precious metals, where we have about 16%. We have very little in what I call platform businesses. We used to have quite a lot. We've now down to about 16% in platforms. So that includes the Googles and the Microsofts, but also things like bookings.com. So those we continue. And then we've been sort of moving much more around the idea of atoms rather than electrons. So the whole concept here is physical production capacity. And that gives you opportunities then in chemicals. It gives you opportunities in all sorts of old-style businesses, which are not expensive against the leaders and are quite cheap against their own history. And so I think there's quite good money to be made. So overall, I'm not massively bullish because of this lake of credit that has been misallocated. You see it with the Blue Isles. You see it with these various failures. And I think anyone who gets too optimistic about, let's call it the end of this war in the Gulf or whatever it is, must just keep in mind that the liquidity that was generated post-COVID or around COVID, that hasn't fully dissipated. And so you're still getting odd signals, and I think they're coming home to roost, and with the Blue Owl type of liquidity problem.
What are some of your top holdings right now? You talked about Korea, Asia,
Yes.
Canada, precious metals,
Yes.
different types of chemicals. What are some of the stocks? Can you share some
sure.
of the names with us?
So our biggest holding is Samsung.
That was your biggest holding 3 years ago, I think,
And
when
what I do with
I
it-
interviewed you last.
Was it? What I do with it, I oscillate. I build it up and I put it back, because underlying it all is a long-term growth trajectory, which is quite nice. And it was very evident to me that DRAM was going to be a problem. Once we started to do this high bandwidth memory, we're stacking 12 of these DRAMs on top of each other. You knew there was going to be a shortage of DRAMs, and it's going to be a big problem for a lot of phone makers, for the game player makers like Nintendo, which we have been accumulating into this weakness. So there's a name. I mean, we think that's a remarkable franchise that's starting to look quite cheap now. So yes, so Samsung remains the biggest holding. And then the other biggest category is precious metals. So here I'm using the two platinum producers in South Africa, Valterra and Impala. What's interesting about these companies is that they are making margins of about 1,000 at the current price. You compare that with the gold producers, they're making about 4,000 at the current price. So the platinum price went nowhere for about 15 years at $1,000. It just stood there. Costs have been going up. Production has been waning. Reinvestment in the mines has been dropping like a stone. Production has been falling. So suddenly here you've got a confluence of events that really give you a massive change in pricing. So I think these companies, which are on 10 times now, could be on 5 times if the price of platinum goes up to where I think it'll go, which is above 3,000. So then they're not even on, they're very low single-digit PEs. Now,
Wow.
the market will look through that, but even so, I think you'll get the crowding into some of these stocks. And then we've got the other precious metals are just golds and ETFs of gold.
Oh, okay. Yeah.
Yeah.
So you've benefited over the last.
And it's been quite good.
Yeah.
The last year we did 30% plus. So it was a good year for us because, we were then freed. The market was no longer obsessed about AI and all the problems with that. So it was a good break for us.
How do you feel about gold today? Obviously, it's had a massive run, but there's still quite a lot of geopolitical risk in the world. There feels like there's a lot of fear. So people continue to crowd into gold. Do you see that gold price going even higher?
I was a little disappointed the other day. I was walking down Martin Place and the
There's
queues
no-
are gone.
The queues are gone.
I was appalled. I thought, what's
Yeah.
wrong with these guys? No staying power. No. I think gold goes higher. Over the next couple of years, it goes higher because the world is fragmenting. It's not just Carney talking about this fracture. It's very real, and I think as a consequence of what happens in the Middle East, and no one can know how it ends up, there's going to be turmoil for a long while, and then you're getting these trading blocks set up. So that brings us to the other favorite of the moment, which is looking at these emerging markets again. They started to catch on middle of last year, but I think they've got a long runway because in most cases they're resource rich. So we're quite excited about the opportunity that this gives them. And the dollar is softening. Now it's bounced overnight, but I mean, the dollar, I think, is starting to decay in terms of its principal position. And that's why stable coins are so important for the regime. They're trying to lock up dollars that then fund their deficits with treasuries. So it's a very important move, and we were quite quick onto that one. But we think some of those countries are looking quite good now. Their balance of payments is improving. People like Mele in Argentina is transforming that country, and he was written off by conventional economists, and he's proved them wrong.
Do you see the end of, I guess, this era of the US leading the world?
It's gradually cracking. And I think coming out of these problems and, the broken promises to the electorate, I think there are going to be a lot of issues for him to face. Whether we have midterms is going to be interesting, and how they're conducted will be even more interesting if they are.
We talked a lot about gold today. Yes. Do you hold gold in the portfolio? Do you think that's important?
Yes, it is. I think it's the ultimate medium of exchange. And I know it's been bagged for a long time, but it's proved to be correct. And I think if China and its ambitions are realized, I think you'll find the renminbi will be partially backed by gold. And I think that'll be part of the selling proposition. But no, I think you've got to have physical gold. And as I say, I love platinum because obvious connotations, but it's a precious metal that's been undervalued now for about 15 years. And I think that will go up a lot. And in fact, I'd prefer to play platinum than gold at this stage, even though I think gold's going towards 7,000-8,000.
Wow. And how much gold and cash do you have in the portfolio right now?
About 20 in cash and another 10 in physical.
Wow.
Yeah.
And why do you think that's important to have that much exposure to?
Well, firstly, you've got to be a nutter. and secondly, I don't need the money. So it makes it a little easier for me to have a big exposure to gold, which is a bit immodest, but I'm being factual. And thirdly, I just think that over long periods of time, it's paid off. Most of us have myopia when it comes to investing, and we're concerned about missing the next opportunity. And if you just hold with it, it should be quite reasonable. Remember, we are now mining at grades of 1.5 grams. So 1.5 particles per million. That's what we're mining at. And our average cost of extraction is, as I say, about $1,400-1,500 US, whereas the price at the moment is 5,400. Whereas in the case of platinum, it's only 1,000 over the current cost of production. So that's why I tend to favor platinum. I know you can give me counter arguments, but remember there are two principal producers of platinum, the Russians and the South Africans. The Canadians produce a small amount, but it is the South Africans are the principal producer, about 60% of the platinum group metals. And these are strategic metals. These aren't something that are common.
What are they used? What's platinum used for?
Well, you can use them all sorts of, first for catalysts, and either in refining materials or whatever. But also, increasingly now, we're using them in these sensors, whether it's picking up oxygen in the content of something, or it's all sorts of semiconductor-based detectors. Platinum is important. And silver is even better. So all these missiles they send off, one of them carries about, I was told, I don't quite believe it, but 22 kilograms of silver. But it doesn't matter, whatever the facts are, in terms of how much. But we know in munitions and so on, there's a lot of silver. So silver, I think, is probably a bit overboiled now, but it's an interesting metal.
So perhaps another commodities supercycle.
I just think that's why we're looking at chemicals and oil. That's why we think that those are probably the next big opportunities.
You obviously like emerging markets right now. Which emerging markets do you think are particularly attractive? I feel like there's been a lot of conversation in the market around, I know Japan's not an emerging market, but Japan, India, Korea.
Japan's getting better expressed now. It was a gift. 2 years ago it was a gift. I think it'll be places like Brazil and what have you. And at the moment, concern is Lula and, what's happening there. But I think they've moved away from that confiscation mentality of, you can't have decent economic rents because it belongs to the people. I think they're very well aware now they need foreign investment. It's overall is beneficial, and it gives them a lot of leverage in this new world where American influence might be waning. I think it is, but we'll see. I'm pretty sure it's had a very good time in the sun. And of course, China, even with its problems, is just so much more competitive, and it's got so much more heft in terms of production. Yeah, so I think it's places like Argentina and Brazil, and companies like Petrobras are a lot cheaper than traditional, the rest of the oil patch. So I think they're quite interesting.
With those regions, do you think advisors could use like broad-based ETFs to get exposure, or do you think it's best to choose an active fund manager or do stock picking yourself?
I think an ETF would be perfectly fine.
Okay.
I think so, yeah.
You obviously are bullish on resources and commodities. Yes. Are you invested in any companies on the ASX?
That's the unspeakable number of companies above my 60 core.
The tail end, the fun end of the portfolio.
So they're just speculations, but they've been okay. There's a little company called Empire. It's got one of the greatest, they claim, TiO2 deposits in Western Australia.
What is TiO2? What is
titanium dioxide.
Okay.
And it's a very pure deposit, literally, at ground level, no mining, just strip away a very small amount of dirt. It's actually wheat fields. And they claim to have unusual qualities for their product. So that's looking interesting to us. Now, there's some real horrors in the portfolio. There's a company called Sky Metals that is trying to produce some tin and is looking quite promising, actually. But, these are speculative. These aren't for, careful
not
investors.
Recommendations.
No.
What do you see as the biggest risk in markets today? Obviously, we've talked about geopolitics and the risk of, I guess, further war. Do you see any other risks?
I think it's oil supply.
Right.
Because it's a marginal effect. It doesn't need much choking off to have a massive effect on the total value of trade in oil. At the margin, you're suddenly either have it or do not have it. And that's the one problem with my case for the Korean won, because, they'll just get choked if they can't get themselves. Fortunately, they get quite a lot of gas from ourselves and condensates from ourselves. So Australia's not badly positioned, and you're seeing it in the Aussie.
I know your chart. I ask every person on the podcast where I'm going to and taking over the podcast to bring along a chart that they think every advisor, every investor should be looking right now. I know yours is related to that. Can you tell us a little bit about it? Well,
it's this whole view about commodities have been in a relative bear market against. You pick the index you want, but against Wall Street is good enough, and because that's 65% of the MSCI. So if you look at oil against the S&P, it's close to an all-time low. Now it's kicking a bit overnight, but I think it actually should go into a stronger trend. U.S. shales look like they're starting to run out of extra capacity. They're stabilizing. And then generally, I think you're just seeing a tightening of the oil market. And when 10 years ago, we thought peak oil was about 95 million barrels a day. It's now running, I think it's about 105. So we still keep finding the stuff, and we're not going off it, contrary to the view we might have had 2 years ago. No, oil, I think, is an interesting one. So this is Brent versus gold, and gold versus the S&P is obviously the opposite. So this is the same as the S&P, and that's looking at commodities.
So would you be investing in oil today then?
Yes,
Do you have any oil stocks in the portfolio?
We do.
What stocks?
Petrobras is nice. Then we've got Oxy in the States. We've sold out, unfortunately, a little early in our Impex, which has been a huge stock. On account of changing tax laws, I may as well realize some profits before I lose my indexing or something else. So I'm very happy to take my profits where they've been made. But I'm adding to oil right now.
Is this the biggest opportunity of 2026, do you think?
Can't know. And it sounds a terribly boring idea, but I suspect it's not.
What would be then?
A more boring idea or a better idea. I think just keep with atoms, don't play with electrons. That I think is the big message. And look to where the money has been avoiding, which has been oil, commodities. I know they've had a bit of a run, but agricultural commodities, fertilizers starting to tighten now. All that very dull stuff, which is where you actually have fixed assets, you actually have to spend capex, you actually have to bring things online, and that takes time. I think those are going to be quite interesting assets. The big problem in chemicals, which is an area we've been adding to, is the Chinese have just, completely flooded the zone And so they used to spend about, 28% of global capex on chemical capex. They've now taken it up to 45. But I think that's going to turn now. So we think chemicals could be huge. And so if you look at the States, they've got an unusual position where they've got the plant in place. They've been increasing their investment in research and development, much more than is generally understood. And these companies have very good energy supply, in terms of gas and oil. So I think the US chemical stocks are really interesting.
What, can you share some names?
Well, there's Huntsman, there's Westlake, there's Olin, there are a whole lot of them. But they're well worth looking at. And if you look at the charts, they're breaking up now. No, I think they're a good opportunity.
Okay, come to the end of the podcast.
Right.
What do you think is one thing advisors should take away from this conversation?
We've had a very long bull market. We've had returns that are well above the long-term trend.
Mm.
It's partly higher profit share. It's partly re-rating. The prospect of AI is to not increase the bargaining position of labour, but labour has given about as much as it can into the equation. Labour's been surrendering share to the corporate sector. That must stabilise or your system starts going down. And that's what I think Trump's trying to do. He's trying to address the decline in manufactured and other jobs in the States. And that's what the big agenda is. It's not him just blowing off, I don't think. He's actually saying, without this change, we cannot be strong against our adversaries, and they choose to have a lot of adversaries. But he's trying to rebuild that backbone, which still exists in Europe. So when people write off Europe, I rather reject that because I don't think it's realistic. Now they've got this big spend on particularly defense or aggression, call it what you like. That will shift things, and they will rebuild some of their manufacturing in other countries other than Deutschland.
Thank you so much, Kerr, for your time today. I
Sure.
absolutely adored talking to you, as
sure.
always. Basis Points by Equity Mates is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.